There's been more selling than buying. And that extra selling that normally went into treasuries, in my mind, has gone into gold. Why? Not only has it doubled the performance of the treasury over the last, at least since the beginning of the century, but it has no counterparty risk. And we've talked a lot about that, the weaponization of the treasury market. You and I have discussed that at length. And equally as important, and going back to the lack of journalistic integrity in the media, gold is the only other tier one reserve asset in the world alongside U.S. treasuries. Why don't more people know that? It seems to me that should be something that everyone knows. If we know that the U.S. treasury is the supreme asset, the most liquid tier one asset in the world, why would we not be told by an unbiased media that gold has been transformed or raised to a tier one status? Well, we haven't. So that's one issue, lack of understanding, and gold has outperformed just about every traditional asset for better part of the last 20 years. It's as I mentioned, double the 10-year treasury. It's beat the S&P 500 just barely, 9.9 versus 9.6 since 2000 with dividends reinvested even. So it's a strange time, to say the least. And I think when you see that the United States, as we talked about last show, has become a net importer of gold since November, it becomes even more interesting, with the largest deposits we've ever seen into the COMEX market ever. This should be front and center in the February contract. 5.9 million ounces of silver or gold were delivered. That's the largest delivery ever for a single month ever. JP Morgan, who only buys for their clients, according to Blythe Masters, who used to run their metals desk, delivered $4 billion in gold into the COMEX in February. Why isn't there more talk about that? Who's got $4 billion as a client to have shipped into the COMEX? These are very interesting times, to say the least. Gold has surged by $500 an ounce in 213 days, from 2,500 to 3,000. That's the fastest $500 price jump in history. No talk about it, no fanfare. In my mind, the smart money has already shifted to precious metals and in front of potential market trouble. At the same time, you have the hedge funds with their lowest exposure to the Mag 7 in over 24 months. You have a 7-to-1 insider selling to buying. At the same time, you have institutional investors who have increased their gold positions by 45% since 2021. And as I mentioned, the metal has outperformed the S&P 500 again over the last 24 months. You can go back even further and find that to be the case as well. The big money is quietly positioning, and all we hear about is the Mag 7 and Bitcoin. So I think that's certainly something to keep an eye on. And there's still manipulation going on. One of the things that people are talking about right now is this really big short position in PSLV. When people have asked me about buying ETFs, I say GLD and SLV are two of the worst products ever made, and on a multitude of levels. And if you read the prospectuses, pages 6 through 12, titled Risk Factors, you'll understand that. The custodian has done a tremendous job at distancing themselves from any fraud or liability. And guess who that custodian is? Well, in both cases, the primary custodian is JP Morgan for both SLV and GLD. And by the way, that's the company who paid a $920 million fine to the Justice Department for manipulating the metals market a couple years ago, the largest fine they ever handed out. Yet, here we are, they're controlling the largest silver trust in the world and one of the largest stockpiles of gold in the world, alongside BlackRock. And so what's been going on with PSLV is, when people would say, well, I have to buy paper with the fund that I'm in or the account that I'm in, or I can't buy physical. Well, I would say buy PSLV. Eric Sprott's an amazing guy. I've known him a long time, although he's pretty much out of the loop now. I would always say that in a world of paper, PSLV and PHYS is the best choice. But you look at what's going on there and you got to wonder, is that even good advice anymore? You go back and listen to Rick Rule interviewed last time there was a massive uptake in, blow off in silver and huge investment into PSLV. They had to go into the open market and buy everywhere and anywhere they could, whether it be London, whether it be the United States, COMEX, wherever they could. And they had a hard time filling it. So when there's greater demand purchasing of PSLV, which is the Silver Trust, they need to then go into the open market and buy silver. So conversely, if there was massive shorting of PSLV that overwhelmed the number of purchases, they don't need to go into the open market and buy copious amounts of silver. And we keep hearing about all of the silver shortage everywhere at the highest level in COMEX and LBMA. And the LBMA, there is a massive silver shortage, huge silver shortage, in the respect that they've delivered 44% of the float, the amount of available silver in the last 3 months, and now have gone from a T+1 settlement in London, meaning you do your trade on Monday, that's T+1 Tuesday. Silver should be moving on Wednesday. They're now saying 8-week delivery delay due to constraints with lack of trucks and personnel. I mean, it sounds more like a default to me. They're freaking out. And you're seeing huge deliveries coming off of LBMA and COMEX and the Shanghai Exchange. Big money is standing for delivery, and silver is becoming hard to get. And when you have huge naked short positions, where on the LBMA market, they're trading 3.5 times annual global mine supply every single day, according to some of the LBMA market analysts. Even though they only post that they're doing 290 million ounces a day off of 270 million ounce float, it's already more than the float. But at the same time, they say those are only the final settlement numbers, and they're actually trading 10 times more than that throughout the day. You have a situation where if just a very small percentage of the people who own these contracts stand for delivery, there is a very, 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 very big problem. And the same thing is true with the gold held at the LBMA. They have a situation where they have 36 million ounces of gold standing behind 380 million ounces in spot contracts that could stand for delivery. 1/10 the amount of gold behind it. Same thing with silver. So the participants, they don't want people going in. The people who are short, the banks who are massively short, they don't want to see the price rise. It's an existential threat to these naked short positions. So if there is this huge demand for PSLV, you keep hearing silver squeeze 2.0 and talk of let's squeeze the banks, and then the PSLV or Sprott has to go into the market to buy more silver. Well, in 1 minute yesterday, 1 minute, 1,314,107 shares were dumped onto the market in PSLV in 1 minute. That's more than you would see in weeks sometimes. And that's shares that were being sold short to drive down the price. Not only the price, really more so to drive down the ability or the demand or the need for the custodian to go in and buy more silver. So it had to overwhelm the amount of interest, new interest into it, so that they don't have to go into the open market because there's more short than there is long here, imbalancing it. This is a big deal. I mean, the lengths that they're going to drive down the price. They're not shorting physical silver at the moment. They're shorting PSLV because they're afraid of them going into the market, demanding so much silver that it pushes the price up. And then these naked shorts have a real big problem. And to the context of shorting and rehypothecation, I was reading something the other day. It's SEC Rule 15C3-3 in the United States. The Securities and Exchange Commission, SEC, regulates rehypothecation through Rule 15C3-3, which limits the amount of a client's securities that a broker-dealer can rehypothecate to 140% of the client's debit balance. Well, that's great. So they can take everything you have and sell it or rehypothecate it 140%. So they take those shares that people have, and then they take it and lend them out to others, who then dump it onto the market to the tune of 1,314,107 shares to stop the trust from going into the open market. This type of rehypothecation, this type of naked suppression, this type of manipulation reeks of desperation in the end games. And I saw a tweet the other day, when we think about all of the silver coming in to the United States. Also, huge amounts, record amounts, most of it coming from London, amounts that no one's ever seen before, ever. In fact, I think the March contract, we will have somewhere in the neighborhood of 85 to 90 million ounces of silver delivered into COMEX in March. I mean, these numbers are off the charts. President Trump made an interesting tweet in 2017, 1/7/2017. He says silver is the most undervalued asset on the planet. It's been money for all of human history, and yet here it sits at $16.50 an ounce. Sad in capitals, exclamation, exclamation. It's doubled since then. He knows, he understands it. Maybe there is something deeper going on with gold and silver importation into the United States, reshoring of it, the rehypothecated or leased out gold and silver is now rushing back into the States. Why is there still such a big short position? And why are the banks doing what they're doing now instead of naked shorting physical silver, which is really dangerous, going in and naked shorting PSLV to keep them from going into the open market and to buying more? That, again, reeks of desperation and of much higher prices. We did just see another big event in Shanghai. The four biggest property casualty insurance companies in China have become full members of the Shanghai Gold Exchange. If they take just a fraction, 1 or 2 or 3% of their funds and put it into silver, you will see a moonshot to the nth degree. Why now are property insurance, property and casualty companies in China being allowed to invest in gold and become full members of the Shanghai Metals Exchange? It doesn't matter why. You should just understand it's significant. And if they can add that to their insurance portfolios, which, billions of dollars deep, you're talking huge amount of firepower added to the Shanghai metals market. These countries have understood what we have been doing by suppressing the paper price, and they're using it against us. They're using it against us to accumulate and drain the exchanges the same way it appears the United States is doing right now with London standing for delivery. And that's the thing that never happened before. That is the one thing that changes everything.